Hello learners! In this presentation, you will understand about standard costing and break-even analysis. Standard costing. Standard costing is the practice of estimating the expense of a production process. It's a branch of cost accounting that's used by manufacturer, for example, to plan their costs for the coming year on various expenses such as direct material, direct labor, or overhead. The main features of standard costing are as under. It helps in measuring the actual costs of the product, comparison of actual costs with the predetermined standards made in order to determine variances, setting of standards for each element of cost, such as material, labor, and overheads. Objectives of using standard costing system. Within an organization, there are several objectives that a standard costing system may be establishing to help achieve. First, a standard costing system may be used to control costs, which is achieved mainly by setting standards for each type of cost incurred: material, labor, and overhead. This also helps to analyze variance and, hence, enables managers to be effective in controlling the costs for which they are held responsible. The second objective that a standard costing system may be used to achieve is to help in setting budgets. Third, such a system may be used to provide useful and detailed information, managerial planning, and decision-making. Fourthly, a standard costing system may be used to assess the performance and efficiency of staff and management. Finally, standard costing is a control technique that follows the feedback control cycle. Therefore, the feedback system may help to eliminate unwanted costs in the future, leading to a potential reduction in costs. Break-even analysis. Break-even analysis entails calculating and examining the margin of safety for an entity based on the revenues collected and associated costs. In other words, the analysis shows how many sales it takes to pay for the cost of doing business. Components of break-even analysis. Fixed costs. These costs are also known as overhead costs. These costs materialize once the financial activity of a business starts. The fixed prices include taxes, salaries, rents, depreciation cost, labor cost, interests, energy cost, etc. Variable costs. These costs fluctuate and will decrease or increase according to the volume of production. These costs include packaging cost, cost of raw material, fuel, and other materials related to production. So, as you can see, every economic entity must present its financial information to all its stakeholders. The information provided in the financials must be accurate and present a true picture of the entity. Thank you.